One renowned retirement expert and former Goldman Sachs banker is stepping forward and revealing his number one way to beat inflation. It's a way to receive a nearly 10% yield from the government with virtually no risk. Folks who take the 3 simple steps he's sharing right now could receive nearly $1,500 from the US Treasury in as little as a few months. Best of all, it's guaranteed by law, and you could pay 0 taxes on this low-risk investment. Considering how rapidly inflation continues to soar, you don't want to waste any time missing out on the potential profits he believes are in store for this investment. So to get a copy of his new free report with all the details, simply go to beatinflation2022.com. Again, that's beatinflation2022.com for a free copy of his new report. Rick Rule in person with me here at the Swiss Mining Institute in Zurich. Lovely seeing you again, Rick.
Always a pleasure, Daniela, in any continent, any country. Thank you.
Absolutely. I listened with great interest your opening keynote, which, by the way, standing room only. They had to bring in extra seats. That's how packed it was. And, you know, the gist of it was that you feel people are too short-sighted, that we look at things in quarters, and that's probably the mistake we're making. My point is, let's talk inflation and get your thoughts on where you think we are at in the cycle, because one of your main points is this is not going to go away in a quarter or next.
So 3 comments that sort of come up in response to your question. The first is that no, inflation is not going to go away. In the near term, I would expect that the inflation numbers will fall a little bit because they've been inflated as a consequence of a recovery of the US economy, in particular from COVID. That is transitory. But the real inflationary pressures don't have anything to do with the real economy. They have to do with quantitative easing. They have to do with the effects of debt and deficits, and they have to do with negative real interest rates, which punish savers and favor spenders. And the first point you made is the more important one. In terms of understanding inflation and coping with inflation, don't think about a month. Don't think about a quarter. Unlike you, I'm old enough to have been around for the 1970s. And the truth was that inflation was incipient in the 70s, really from 1968 to 1974. But because people had lived through 20 benign years before that, although they knew inflation was occurring, it hadn't bitten them yet.
Right.
And it took 4 years of experience with inflation before people felt their living standards were impacted. And the same thing is happening today. People understand intellectually what 8.5% inflation is, but it hasn't affected their living standards yet. When it does, yes, I understand. People go to the pump and they're afraid.
Yeah.
They are angry at
Yes.
paying more for gas, but it isn't impacting their ability to buy cars yet. It isn't, they haven't noticed the fact that 8.5% inflation against a 50 basis point yield in their savings products impacts the spending power of their retirements yet. They understand it empirically, but they don't feel it emotionally yet. When they do, I think that the response will be severe and dramatic, like it was in the 70s.
Okay, let's talk about what you mean by severe. What kind of reaction is that? What does it look like?
I think that when people understand arithmetically that over 4 years, that the spending power of their retirement has declined by 25%, that people will change their behavior, and they'll change their behavior dramatically. For the last 40 years, buying bonds in a retirement account has been a very good thing to do. Now bonds are what Franz Pick called certificates of guaranteed confiscation.
Right.
People don't notice that in the near term, but a change in investing habits, as an example, which would cause disintermediation, which is to say a switch out of a bond portfolio into a more inflation-oriented portfolio, would be an absolute sea change in investing. And I think it's going to happen.
Okay, and what does that mean for the bond market?
I don't know. I mean, to be honest with you, you weren't around in the 1970s. I don't know if it'll be as severe as it was in the 1970s. But in the 1970s, despite the best efforts of central banks, they would have U.S. Treasury auctions that people wouldn't show up for. That was a severe time. I'm not trying to say it'll be that severe. I'm just trying to say that people need to begin to get themselves in the frame of mind to think beyond the quarter.
I've had other experts on saying this will break the bond market. Would you go as far as to say that?
I mean, credit markets will never be broken. But people who act as though the credit markets will be unchanged will go broke. That will happen. The bond market won't be broken, but some bond investors will be irretrievably broken.
I'm really curious to get your thoughts on where you think the blame lies for inflation. There's been a lot of finger pointing. Folks will say it's the America Rescue Plan that added, 1 to 2% of the inflation. Biden will point to Putin. Oh, it's the war. What got us to this superinflation we find ourselves in?
Daniela, the greatest political commentator of all times was a cartoon strip character called Pogo. And Pogo said, I have met the enemy, and he is us. As a society, what we've decided to do is live beyond our means. It is very popular with the voters to enjoy all kinds of benefits today and leave the cost for the younger generation. If you think about, as an example, the off-balance sheet liabilities of the U.S. government, which is one of the causes of inflation, what that has to do with is old, fat, bald white guys like me have voted ourselves all kinds of cool benefits, and we've decided that you should pay for them. That's the nature of inflation. We have consumed and we have financed that consumption with 30-year debt that isn't backed with anything. Think about what negative real interest rates are. Negative real interest rates are old people consuming today and young people forestalling consumption in favor of older people, and the older people promise to pay them back less than they borrowed. This doesn't occur without a political construct. If you think about one facet of politics as being a war between spenders and savers, which is really what fiscal policy is about.
Right.
Savers are scarce. Spenders are numerous. In a democracy, the spenders will always outnumber the savers. And so I think that the reason for inflation is a lack of understanding of arithmetic among voters.
Does it get fixed?
All these things fix themselves over time. I was around for the last fix, which was Paul Volcker, taking the interest rate on the U.S. 10-year Treasury from 5.5% to 15.5%. And it was ugly. It was profoundly ugly. It only lasted 3 years. The pain only lasted 3 years. The problem was when Volcker went to work, federal government debt to GDP was about 25%. Now federal government debt to GDP on balance sheet is 110%. So we have fewer tools, and the process of curing it is going to be more challenging.
Let's talk about the tightening cycle. I've had people on saying the Fed simply won't be able to keep raising interest rates. What are your thoughts on the Fed's strategy and whether they'll be successful or not?
I think right now they're doing the right thing. I think they have to let interest rates rise as long as they can, as far as they can. I think they'll chicken out.
In raising them?
I think they'll chicken out when they've succeeded in raising them. Over the last 40 years, the U.S. 10-year Treasury rate has had a positive yield after CPI stated rate of inflation. The CPI stated rate of inflation is 8.5% now. That would mean that the U.S. 10-year Treasury rate would have to be 9%.
Right.
That would mean that the interest payment on federal, state, and local debt would triple. Traditionally, the 30-year fixed mortgage rate has traded at a premium to the U.S. 10-year Treasury, which means that 30-year fixed mortgage rates would have to go to 9.5%. Think what that would do to young people's ability to buy houses. If we had a period of real interest rates, it would certainly cure inflation, but it wouldn't cure inflation before it did amazing damage to various balance sheets. And so my suspicion is that as interest rates rise, before they even got to real yield levels, that the damage to the economy and the pain and anger that it would inflict among voters will cause the Fed and the political class to chicken out.
And reverse course?
Yeah.
But what about the optics, though? I would think that, here they are saying, oh, no, we got to raise interest rates.
Yeah.
Wouldn't they care how that would be interpreted or look if all of a sudden they just reverse course?
I suspect that the change, when it occurs, will be dramatic. My suspicion is that they will have to change course because the political demands will be too heavy. That happened in 1975. I watched it happen once before. They were doing the right thing in the middle part of the decade of the 70s. The economy tanked and they lost their nerve. They wouldn't take the pill. What happened in the middle part of 1975 was that investors stopped showing up at treasury auctions. They gave a treasury auction and nobody came. And that was really truly problematic. If you had an event like that, which is to say where one whole bond cycle had to be accommodated by quantitative easing, I think that you would have a very different economic outlook. I can't tell you what it would look like, but I can tell you that the complacency which has accompanied 40 benign years in the economy from 1982 to 2002 would be over. I can't tell you how it would be over. I can't tell you what it will look like afterwards. But I can tell you that you can destroy complacency in the same fashion that we did in the 1970s.
I want to circle back to my opening point about short-term vision, and that's kind of what was the core of your message. And we're at a mining conference, and let's talk a little bit about the space here, because you were saying the biggest mistake is, we folks don't want to hold these stocks for longer than a weekend. But you found in your life the greatest returns usually take 5 years. Can you talk to us a little bit about that? Because I thought that was interesting, because 5 years...
Buffett says the same thing. He said that the ninth wonder of the world and the first wonder of finance is compounding. You don't compound in a month. The truth is that compounding takes time. Buffett says the ideal holding period is forever. Most people don't want to be rich, they want to live rich, so they want to sell stuff and spend it. For the people who want to be rich, it takes time. It's ironic that when I was in my 20s, and I had all kinds of time left on earth, I too thought in financial terms about what I wanted, which is to say, I thought that 3 months was a relevant time frame. And the consequence of that is I didn't make much money. Ironically, at 69 years of age, with not so much time left on earth, as an investor, I've lived through 11 5-year cycles. So it seems less daunting to me. Specifically to my message yesterday, in the more speculative part of the mining market,
Right.
To enjoy a 10-bagger, for those viewers who aren't familiar with colloquialisms, that's 1,000% gain. In my experience, a 10-bagger doesn't require something to go right. It requires 2 or 3 or 4 things to go right, which requires time. So most of the 10-baggers or 20-baggers or 30-baggers that I've enjoyed in my career have required 5 or 6 years. And by the way, in most of those 5 or 6 year periods, the stocks in question have declined by 50% in price.
Yeah.
And so in addition to having patience, you have to have knowledge and you have to have tenacity.
I'm glad you brought that up, because I remember when you said that in the talk, I thought, well, how do you know? Because you said you don't necessarily have to panic if it was at $2 and it goes to $1.
You have to be greedy.
But how do you know it's not a dud?
That's the best question of all. That probably should be the subject of a second interview. Most investors pay slavish attention to price because it's easy information to get and it feels spendable to you. But if you don't have an opinion as to value, what is price information worth? A stock is selling for $1. Well, what does that mean? It's a floating abstraction.
Right.
If you think the stock is worth $2,
Right.
then the fact that it's selling at $1 is a very good thing. It means that you are buying $2 worth of value for $1. Most people have no opinion as to value. The fact that most people have no opinion as to value, or have no means to develop an opinion as to value, means that the information that they pay attention to, the price information, is a floating abstraction. It has no import whatsoever.
Makes
When
sense.
people develop an opinion as to value, then price becomes relevant. If you think something is worth $2 and it's selling for $1, you buy more. If you think something is worth $2 and it falls from $1 to 50 cents, you don't panic, you get greedy. You buy much more. If the only information you have access to is price, the fact that it fell from $1 to 50 cents is a bad thing. But if you have an opinion as to value, it's a good thing.
You have to have belief in what you're buying.
And
Conviction.
Knowledge.
And knowledge.
Yeah, well, conviction, proper conviction, comes from knowledge.
Really good thoughts. Rick Rule, bring it home for us, for all our viewers watching. This is so special. I'm so happy to be here with you in person.
Well, I think the most important lessons that you take from this is that the most important investment that you can make is in yourself. Develop the ability to do at least cursory securities analysis. Develop enough knowledge yourself that you can form an opinion as to value, which would make the price relevant. Understand, too, in finance, that you need to make investments where time is on your side. You have to enjoy compounding. The fact that you want something to go up soon is interesting, but it's not relevant. The market doesn't care what you want. It's only what you can have. So developing the conviction to own stocks long enough that they can compound and make you wealthier is the process by which one becomes wealthy. Otherwise, you may as well do something like play baseball or read comic books, or something that gives you some intermediate time value of money.
Well, really, really well said. And if the crowds here at this conference are any indication, it looks like we're in quite a robust environment here in the mining space. Would you not agree?
I can't tell you anything about sentiment. I can tell you that the values today, relative to what I think the values will be like 5 years from now, are very, very good. It's a compelling time to be in a business.
Rick Rule, it's an absolute pleasure. Always nice seeing you.
My pleasure, ma'am.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.